I'm Dave Thornett and I manage the Key Fund. We are a social investor. We make grants and loans to social enterprises and trading charities. Importantly, you have to be trading. Debt doesn't work for you if you're not generating any income. Key Fund's been around since 1999. We're one of the older social investors, albeit smaller in terms of the amounts that we lend. We specialise at the lower end of the market, and I'll come on to that in a little bit. There are a number of social investors out there who make grant and loan investments, but also equity in some circumstances, again, which I'll touch on shortly. And I've put up 3 links just on the chat box. The first, Good Finance, which you all might find quite useful, which is a very new, launched a couple of weeks ago, website, which is brought together by a number of the sort of market shapers around social investment. And you can go online and you can put in theme of business, geography, type of investment, amount of investment, and you'll be able to find out who invests and make approaches to them and see which is the best fit for you. The second, Big Society Capital, is an organisation that's been around for a few years now and was set up under the last government, the coalition, specifically to do 2 things. One, to capitalise social investors, and 2, to actually develop the market. So can we stimulate demand? Can we increase understanding of social investment and the way it can be used to generate not just economic value, but also social value? And the third, Responsible Finance, which is the membership body for ethical lenders, and that's across private and social economies. So worth having a look at those. Key Fund is one of a number of social investors in the UK. We work around the north of England, which by our definition is the East and West Midlands up to the Scottish borders. We invest between £5,000 and £150,000, predominantly in lending, but we also have split grant loan funds that we use where we think the social value can be maximised by injecting grant in alongside a straightforward loan. We don't price for risk. We have a standard pricing of 6.5% flat rate per annum. And you'll find a lot of social investors work around that kind of level. So if we're thinking about straightforward loan investment, you'll find a number of probably familiar names. You'll have seen perhaps Triodos Bank, a Dutch bank trading in the UK, who are setting their sights not only now at increasing social investment into social enterprises, but have also just launched personal accounts, looking for the ethical pound from the saver as well as making investment. But there are a range of others: Charity Bank, Big Issue Invest, which is the investment arm of the Big Issue Trust, and also now some of the traditional grant-making trusts. One that Darren just mentioned, the Esme Fairbairn Foundation, have now moved into making loans to charities as well as making grants. There's an area that's particular to social investment that's called community share issue, and it works on an equity basis, but within a cooperative model rather than a private profit distribution to individuals way. And the difference really is that whatever your shareholding, your voting rights remain 1 vote per shareholder. Your shares are redeemable, but they never actually accrue in value. You can be paid interest on them, but you can only ever redeem them at the face value. And this is a tool really for bringing together investors to create a particular social value focused on an individual piece of trade. It's very old legislation. It dates back to the Victorian period and has its roots at the foundation of places like the University of Sheffield, which is a penny subscription university. It's being used increasingly for communities coming together to buy out pubs, post offices and shops that are in danger of closing. But it's also been used for things like buying Hastings Pier from property investor, crowdsourcing through a member cooperative to create FC United of Manchester, but also local hydroelectricity schemes and wind power schemes as well. So really useful way of not only creating capital to work with, but to also engage your customer base directly into the business. There are a number of fairly new lenders that are blending grant with loan on a regular basis now. It's something that was reasonably common probably about 10 years ago, but sort of died off because of available sources of funds. But a couple of years ago, a new organisation called Access, the Foundation for Social Investment, was created, partly funded by the Big Lottery, partly funded by loans from mainstream banks under the Merlin Review. And Access specialises in creating new grant loan funds. Key Fund actually has a contract with Access, so we can put out split grant loan investments into organisations, and they will soon have another 9 or 10 similar funds around the country. So it's worth having a look on the Access Foundation website as well. The principle is that the grant is the thing that secures the social value. A social enterprise or a trading charity has two purposes. It has to stack up as a business, but it has to be clear about the social value that it creates, and that value has to be a thread that runs through all the life of the business. It can't simply be an add-on, a bit of CSR at the end of the year. And we have a number of organisations, not just Key Fund, First Arc in Liverpool, Resonance in Bristol, and shortly Greater Manchester Centre for Voluntary Organisations in Manchester, not surprisingly, will be launching a split grant loan fund as well. In terms of the landscape and quantum of investment, Key Fund is probably at the lower end in terms of our entry level, which is £5,000. A great deal of social investors probably don't dip below £100,000 because it's very difficult to make that stack up. The cost of doing a deal for £100,000 is pretty much the same as doing a deal at £20,000, but you make less money on £20,000. The standard range of social investment probably goes up to about £5 million, but there are sources where you can both aggregate different investors but also gain larger sums of money. Hackney Community Transport, for example, a few years ago raised £50 million for a large business expansion. What you'll find is that the lending criteria, the pricing, the risk appetite and geography covered by different social investors varies, but they all collaborate as well, sometimes referring to each other, sometimes doing deals together, and quite often are found round the table together in London sharing notes, which is more about developing the market than it is perhaps any social version of LIBOR rate rigging. So it's a collaborative environment and it's a developmental environment, and quite positive for that. Finally, two of the things that are sort of on people's minds at the moment are the two tax relief schemes that can be used for social investment, and that's social investment tax relief and community investment tax relief. And they work very similarly to EIS and SEIS, and can either be developed as a fund, which people invest in and get their tax relief year on year, up to a maximum of 30% for social investment tax relief, or 25% for community investment tax relief, or they can be applied to individual investments, and you almost kind of crowd fund in using the tax relief to raise money from private investors either individuals or corporates. And whilst the legislation has been around for a while, actually it's not been used very heavily, but it is an area that will grow. And there is a national campaign about raising awareness of this, because it's a huge level of untapped investment, not only in corporates, but also in individuals. And we've seen how that has a real value through community share issue, and still by some margin to raise its full potential in the tax relief schemes.